A very good morning to you. Thank you for joining us on the program. I am Bisi Adebayo. We'll begin today's show with some encouraging words coming from the Minister of Finance, Zainab Ahmed, to Nigerians, saying that there is nothing to worry about regarding the incremental changes to the country's tax laws. According to her, these changes will not necessarily translate into an increase in taxes. Mrs. Ahmed was speaking at the end of the 24th Virtual Federal Executive Council meeting yesterday, where the council also approved the Finance Bill 2020, which will now be sent to the Parliament for assent. Let's hear what she said.
In the Finance Bill for 2020 has no increases in taxes. So there will be no VAT increase. VAT remains at 7.2%. So, and I gave an example of the changes that we're making in the tax law. In the last Finance Bill 2019, we reduced taxes from 30% to 20% for enterprises that have turnover of between 25 million to 100 million. And we also moved taxes from 30% to 0% for enterprises that have turnover of 25 million and below, which means they pay no taxes. What we're doing in the Finance Bill 2020 is to further remove the education tax of 2% for that lower category of enterprises that have turnover of 25 million and below. So when we say incremental, it means gradually making changes. So the changes could be up or down. But for now, with the economic slowdown, our assessment is this is the time to cut down on taxes, to not increase taxes at all, and also to not increase levies. This is the time that we need to do that, and that's what we're trying to do.
Well, let's talk oil prices now. U.S. crude futures fell in early trade today as surging COVID-19 cases and widening lockdowns raised fears over fuel demand, and this has overshadowed upbeat vaccine news. WTI crude futures were down 0.5% to $41.59 a barrel after gaining nearly 1% on Wednesday. Brent crude was also 0.1% lower in early trade, having gained 1.4% in the previous session. Analysts say investors are also booking profits from the recent rally before the U.S. Thanksgiving holiday later this month. On the flip side, the U.S. crude inventories rose 768,000 barrels last week, and that's less than analyst expectations in a Reuters poll for a 1.7 million barrel rise. We'll take a moment now and we'll be right back. Please stay with us.
What? Now this is more like it, right? We want the best quality ingredients when we cook. But when it comes to salt, we care less. We say salt is salt. Well, I care about my salt. It goes into my food and my body. So I use Dangote salt. Dangote salt is high-quality salt that is refined and iodized to give great taste to my meals and also to support my family's health and well-being. It's time to care about your salt.
First time now for research analysts at the financial derivatives company Dumebi to join us to discuss the latest burning economic issues at the domestic commodities market. Good morning, Dumebi. Thank you for joining us on the program. Now, we're still seeing oil prices hover around $44 per barrel, and this also comes just as Nigeria's request for oil quota review was denied by OPEC Plus on Tuesday. What is the implication of this for us?
I mean, the oil market has, been whirled several times this year due to several reasons, and just of recent, the rise in U.S. crude stockpiles, increase in Libyan oil production, the spike in COVID cases in Europe and the U.S. have, brought oil prices down. But the vaccine optimism and OPEC, possibly, reviewing its decision to ease supply cuts, has also kept market sentiments positive. So, but I mean, there are concerns that oil prices would actually fall further and trade around $41, $42 per barrel in the coming days or weeks, and this is because there's currently an OPEC dispute, as to whether to cut or not to cut oil production for several oil producing countries, and the recent surge in COVID cases in the US. I mean, just today we found out that New York is reinstating and reimposing a lot of lockdown measures and being very strict with it because that's the epicenter of COVID cases in the US.
Now, on Tuesday as well, now bringing things back home, the federal government approved flight resumption for EU carriers Lufthansa, Air France and KLM. Of course, international flights are also to resume at the Enugu, Port Harcourt and Kano airports. How does all of this sit with you?
I mean, the first thing we'll need to look at is the fact that, number one, the aviation sector would start recovering due to these, measures, the fact that international flights are resuming. But in the back end, we're looking at how this is going to affect the currency. So first of all, with international flights resuming, the first thing we're going to see is that there will be an increase in forex demand. And remember the forex backlog that the CBN has already said they're going to clear over the next 15 to 14 weeks, and that's over $2 billion. And definitely, with the increase in forex demand, it's going to heighten, currency pressures. The naira, just as yesterday, we realized that the naira in the black market or parallel market has depreciated year to date by over 30% to 478 naira per dollar. Per US dollar. Sorry about that. And definitely, this just, simply means that the currency will continue to depreciate. It's not looking good for the currency right now, and this is happening alongside external reserves, depleting.
All right, now I was just going to talk more about the external reserves. Of course, we've seen a steady decline in the reserve portfolio now, and we've not even seen the mild effect of the rise in oil prices that we saw before now. Why is this?
The first thing we'll have to look at is with the global oil market, oil prices have been very volatile. And now we're looking at this is coinciding with Nigeria's oil production, declining. And not like it has been declining, because as at the November report from OPEC, Nigeria's oil production for October still increased to about 1.49 million barrels per day, meaning that Nigeria is still not meeting up with its OPEC quota of about 1.4 million barrels per day. And OPEC would continue being strict with Nigeria to ensure compliance, and this simply means that forex inflows are reducing and external reserves will continue to decline because the CBN would keep intervening to ensure that in the forex market to ensure that the naira is stable. And this just puts the country in a very sensitive position. We're having low forex inflows, increased forex demand, depleting external reserves, and a weak currency.
Now, let's talk about the latest happenings at the Nigerian Stock Exchange. Of course, for the first time this week, we saw the bull return to the market yesterday after losing 3 consecutive days. What's your reaction to all of that?
I mean, it's a good news for all of us. It's a good news that the stock market has regained on a positive note. But right now we're looking at this as a very temporary one. Although the reason why that happened yesterday was because of the gain in oil price in the market during the intraday, and definitely what we'd likely see is that investor sentiments could decline because of the current macroeconomic fundamentals. The country currently is still very sensitive, as I mentioned earlier. There's so many things that are going to taper investor sentiments, from lower oil prices or volatile oil prices to weak currency. And so investors right now will remain very skeptic, and they will be very risk averse. So in the coming weeks, we could see the stock market lose the gains it made yesterday.
Well, let's talk about commodities now. Where are we in terms of prices? From your slide that you guys have prepared, we've seen that the price of flour is expected to increase to 15,000 naira per 50 kg bag. What's the reason for this increase? Of course, we're hoping that the price of this will not affect end products such as bread, for instance.
I mean, the first thing that I would look at is, number one, the currency is, getting weaker by the day, and currency pressures are definitely going to affect commodities like flour, and this is because the like flour is gotten from wheat, and most companies that make use of flour in this country, they import wheat, and so the effect of this on the price of flour is that, number one, they're importing at a higher cost. So this will definitely reflect in the price of flour. And we can't negate the fact that this would, actually have an effect on the price of, processed products like bread. And what we might likely see is that consumers, if the price of bread increases, consumers would likely shift, their demand to other carbohydrate substitutes like yam and rice. So, but the major reason why this is happening is because of currency pressures and forex rationing. So, manufacturers who import the raw material, which is mostly wheat, they're getting a huge hit, and definitely they would pass the burden down to the consumers.
But won't the shift to alternatives like yam and rice, for instance, in any case, we know that rice is not exactly cheap at this time, but won't that also lead to a surge in the price of these commodities as well?
I mean, for the consumer, it's almost a lose-lose situation, and one thing that manufacturers might do in terms of, bread, because bread is one of the very cheap commodities that people easily consume and they run to. But what manufacturers rather might do to keep consumers, still taking bread is they might shift towards miniaturization of the commodity. So what that means is they reduce the quantity of the bread loaf so that they don't have to increase the price so much, and they also maximize profit. If, theoretically, if consumers shift to yam or rice, the price of these commodities could increase, and this is because, number one, we're in the festive period. Number two, there are still supply chain challenges for these commodities, and number three, like I mentioned earlier, we're already in the festive period. So, and border closure as well. So, especially for rice, that is, that's majorly, or that has high import content rather.
And it's just been a few days, but are we beginning to see the effects of the recent increase in the pump price of petrol on food items and commodities in the market?
This year, has really been unique. It has really been unique. The price of commodities have remained high, even when we thought the prices were going to go down. So the price of commodities are still high, and with the recent hike in fuel price, we haven't seen that take effect yet. But because this just happened, a few days ago or a few weeks ago. So it's in the coming months. So let's just say by the end of November or beginning of December, it will be more potent. Now it will be more potent by that time. That's when we could see the price of commodities really surge, from what it is now. And this would be coinciding with the fact that it's the festive period, so there could be an increase in demand. But one thing we can't rule out is the fact that consumer disposable income is really down. So there is the increase in commodity prices coming from supply shocks and things like the increase in PMS price and electricity tariff, and there's also the effect of low demand. So marketers are not really seeing the usual festive period increase in demand, unlike previous years. So these are some of the things that could play out, but the most important thing is that for now, we haven't seen the recent increase in PMS price affect commodity prices, and it's been more potent by the end of November, entering into December.
All right, Dumebi, now let's talk about this issue, and that's the fact that Gabon is expecting a 20% rise in its 2021 palm oil output. What is that country doing differently from Nigeria? Of course, Nigeria loses billions and billions to palm oil importation despite being the 5th largest producer in the world.
I mean, Gabon is, it has taken steps to ensure that this commodity that it has a comparative advantage in, it's going to utilize it. So number one, comparing Gabon and Nigeria, we can see that number one, Gabon recognizes that this is one commodity that they can, harness the potential enough to increase their export earnings. And number two, they're ensuring that, farmers in this particular industry are encouraged, they are incentivized so much so that they are encouraged to boost production. Number three, they're involving technology. So the industry in that particular industry for that particular commodity, is receiving a lot of technological boosts. And generally, they're just, intensifying efforts to ensure that palm oil production increases, and they're able to harness the uniqueness of their palm oil in the international market, and just, generally boost their export earnings.
All right, now let's talk about power, of course, moving away from Gabon now. Part of the slides that you guys put up this morning shows that power output has risen about 4,000 megawatts. You want to talk us through that?
The first thing that we would like to point out is, number one, Nigeria is still very far away from its power potential, which is about 15,000 megawatts. And right now, the country is, the country is producing a little over 4,000, megawatts. And when we're able to, surpass 4,000 megawatts, it's a good thing. But the other thing that I would like to point out is that there are, policy measures to ensure that the power sector is, going to, grow further than what it is now by 2021. So the federal government is looking to boost capital expenditure in this particular sector. And, this is all coming because there's the plan or things that, moving fast enough to ensure that the power sector is much more deregulated. And, for example, that's why we're having the cost-reflective tariff that, whatever cost, going on in the power sector, in the market, it's also reflecting in the price of electricity. So generally, it's good news that power is above, 4,000 megawatts, but Nigeria is still far from its potential of about 15,000 megawatts. And there's also the good news that, there are policy directions and measures towards improving power generation in the country.
All right, Dumebi, as we prepare to wind down this conversation, let's just have your outlook for agri-commodities and, of course, oil prices in the coming days.
Okay, starting with oil prices, we would likely see oil prices remain volatile, and this is going to rest on the back of the spike in COVID cases in the US and Europe. And all of this is going to, definitely offset the rising Asian demand, and that's because the fuel consumption in India and China are increasing, but that might not be enough to reduce the negative impact of the rising U.S. crude stockpiles and rising Libyan oil production, and also the spike in COVID cases in the US and Europe, especially with the fact that they are going into a second lockdown. Then for agricultural commodities, we're entering the festive period. Prices are usually higher. So definitely we're likely to see an increase in the price of the major festive commodities like rice, vegetable oil, chicken, and this is probably going to linger till, the end of December.
Many thanks, Dumebi Iyeke, research analyst at the Financial Derivatives Company. Thank you for your time on the program.
Thank you so much.
Still to come on Business Morning, we'll assess the role of a global standing instruction on loan recovery. Just stay with us. Welcome back. In July this year, the Central Bank of Nigeria issued the Global Standing Instruction Guidelines aimed at reducing non-performing loans in the banking sector and to monitor chronic loan defaulters. But it's been about 3 months since the implementation took effect, and many say that it's time to assess how effective the policy has been so far and what role the credit bureaus have actually performed in this regard. Well, joining me to discuss this now is the chairman of the Credit Bureau Association of Nigeria, Mr. Oladimiji Peters. Good morning, and thank you for joining us on the program. Now, for the benefit of those who may not fully understand what we're talking about, please, could you enlighten us a bit more about what the Global Standing Instruction is all about and how it has helped to reduce Nigeria's non-performing loans?
Thank you very much once again for having me. Indeed, in very lay terms, the global standing instruction basically is a trigger on an account that is otherwise defaulting, and a standing instruction to now credits the defaulting account from an account that is now liquid. In other words, in very simple terms, the willingness to perform on loan obligations and the ability to perform on loan obligations are two different things. So what the Central Bank of Nigeria figured was that whilst people had non-performing loans with certain banks and perhaps had run those banks to insolvency and liquidation, they had credits. They had money in other banks. So the trigger basically as a first stage is to identify that the two accounts belongs to the same person, and you are able to say, okay, this credit belongs to the same person though he has defaulted, and the man or the woman has liquid fund or the company has liquid cash in another bank, and the trigger then offsets the defaulting or the non-performing loan at the very basic level. That's exactly what it does.
So how much of an improvement, or how would you assess the loan recovery since this took effect in August?
Well, we're currently monitoring, and unfortunately, we can't say with very clear precision at this time that this is how much we've actually been able to achieve. But so far, because, monitoring happens quarterly. So you look at the first quarter, second quarter, and then third and fourth quarter, see whether or not you have enough changes to make informed decisions. But at the moment, we've seen some triggers, and we are confident that that would continue and would also inform on some of the positive changes we hope to see on non-performing loans.
Now, what role does the Credit Bureau play in ensuring some form of conformity with the GSI guidelines?
Well, for the Credit Bureau, to a very large extent, our Credit Bureau in Nigeria, and indeed the Central CBAN, Credit Bureau Association of Nigeria, our role is very simple. The GSI works hand in hand with credit, and that's where we are involved. And the role we have played so far includes, but not limited to, advocacy, issues of raising awareness or to customers and letting them understand what this new policy means for them. You would find out that the average Nigerian is a very smart person, and for instance, they would say, "Oh well, I do have some funds I have not performed on," but in actual fact, you can't offset that money from a joint account with my wife or with my spouse. But in actual fact, that can actually happen, and that will actually happen. So you can't keep money in a joint account and owe another bank. Even if it's a joint account, that money will go off the account and offset the loan. So we try to raise all this awareness and let people know that this, the things that apply given different scenarios, and just to also inform the general public on how that can affect them and their cash flow. Yeah.
Well, you've talked about awareness, and I'd like us to just talk more about that then. But how would you rate the level of awareness actually with regards to the activities of credit bureau? How much do you think people actually know about credit bureaus?
Well, on a scale of 1 to 10, 1 being very bad and 10 being very good, I would say about 8, 7, 8. So far, but there's still room for improvement. And I say this because back in 2005, 2006, 7, when we started and we say, "Oh, credit bureau, do you have a credit bureau? Do you have a credit report?" People say, "Oh, is that the bureau they change? How much is dollar rate for today?" and you start to, let them understand that. I mean, I had a neighbor at the time, sorry to digress, and I said, "Oh, do you know your credit score?" And he responded and said, "Oh, do we have those around here?" I thought it was just in developed countries like the US. So that was the type of awareness we had at that time. But fast track to 2020, 2019, 2020, what we've seen is that there is more awareness, not just as awareness, there is also acceptance. We see people open up more, understand the concept, and simply because there's been a lot of loans going out, especially during COVID-19 period, supports, whether it's NISAL, BOI, and the rest of them, people are usually, as a first stage, also required to have a credit report of some sort. So there is more awareness now than there ever was. And CBN, CBAN, they've all been at the forefront of it, pushing this, awareness narrative and acceptance and changing credit culture as well.
Now, is credit reporting only limited to transactions with banks and other financial institutions?
No, the financial space in Nigeria has extended far beyond traditional banking and the financial space and other financial institutions. We have seen massive development within the digital space. We've also seen transformation from the traditional a social collection to more developed or full-blown institutions that are actually making massive credit changes in the financial space. So for the Nigerian market, for instance, and this was one of the reports I gave authorities just this week, we saw a rapid change between 2018 and 2020 where, the change was about 100% jump in terms of the hit rate on credit records and credit reports and credit scores. And that has been mostly due to the activities of fintechs, digital platform, USSDs taking loans and hitting credit reports and credit scores to make informed decisions within their own business matrix. And so it's no longer limited to, the usual MFBs, commercial banks, and, it has extended massively. We have people that are using psychometric tests to, make informed decision as to whether or not to give a loan. We have people proactively going into social scores. You have a social, they take your social data, whether on Facebook or LinkedIn, and decide whether or not they want to give you credit. So it's become more proactive than reactive, and the market is extending. We hope to see such extension even further.
Now, earlier on, you talked about the fact that, of course, due to the COVID-19 pandemic and the economic state of the country, so many loans have been given, But does this initiative, talking about the GSI now, help banks and then, of course, you guys, the credit bureaus, do you help banks to be able to tell the difference between borrowers who have been genuinely hard hit by these macro conditions and those that can repay the obligations but just wouldn't want to do so?
Yes, indeed, it does. And again, it speaks to some of the things we spoke about from the very start. And I like to reinforce that message. The willingness to pay a particular loan obligation is not the same as the ability to pay the obligation. So for the GSI, for instance, the trigger usually happens when, there is money sitting in the account to now offset, an outstanding loan or a history of non-performance. And we're able to map this out. The data is very specific. You look at it and you say that, okay, there is money here, and you have a loan somewhere else. But on the other hand, you would also see people who have a history of performance. And this can be captured, in the credit score, because the credit score is primarily based on, your repayment history. So we look at the repayment history and we see people who have a history of performance, who don't have a lot of cash stock somewhere in the bank. And all of a sudden, because of, supply chain issues and all other type of accommodating issues that came with COVID-19 are strongly hit by business. And there are specific sectors that are, affected more. And in those type of cases, we are able to narrow down that this is simply because of the pandemic and not because this person has a strong unwillingness to to default, So we are able to see that as well. So the data set is very clear. You can, from the data, see what is actually happening, and you can tell customers that have a willingness to perform and those that have a stronger willingness to perform also.
All right. Now, with the advent of the Credit Bureau, of course, one would imagine that the issue of credit repayment culture would have improved. But do you see this policy actually facilitating improvement in credit repayment among Nigerians?
Most definitely, the program would change the credit landscape to a very large extent. I mean, if you go back in time, you will see that banks like Savannah and all other banks, AMCON, brought over a lot of bad loans, and you have banks, ETI, doing a lot of specialized resolution to take over bad loans and all that, not to mention names. But the fact of the case is there was a strong credit culture where people collect money and simply refuse to pay back. To most of them, it was pretty much a share of the national cake, but that is changing rapidly. And I think the GSI is just one step further towards that change, indeed. So people know now that you cannot have money or liquid cash in a bank and at the same time owe a bank, and perhaps, if that's depositor's fund, sitting somewhere and you simply refuse to pay back, it's not, acceptable. And before we start going into the recovery stage, like having a buyback or a loan buyback, or AMCON is trying to, I think this policy is more proactive in the sense that it doesn't even get to recovery before it starts to initiate, that the repayment process. So you don't need AMCON to buy back the loan before the repayment is done. Once there is money, you simply get to pay back your loan. And that also helps build everything that we believe in terms of credit culture and credit practices in Nigeria.
What about collateral? Of course, you can't take, a certain amount of loan from the bank without putting down a collateral. So where does this, what happens here?
Well, with collateral, our emphasis, especially 2019 and 2020, so within CBAN, has been to ensure that we move away from collateral to character. It's always been character over collateral. You look at it, how many average Nigerians really have a collateral, a landed property in Banana Island to actually put in on ground and say, okay, take this and I'll pay it back. If I don't pay it back, you can go ahead and take this house. But they don't have that much. And you look at the adult population of Nigeria, from about 200 million, the entire population, you have an adult population of 100 million. Now, within the banking space, what you have within the financial banking space is pretty much 50-60%. So you have 50 million, 60 million grown adults within the financial space. The goal is to now extend into the non-financial space, one, extend into the non-collateral space, and you can only do that by, analyzing character, really, because a lot of these people don't have, they don't have collateral. So the goal this year for CBAN, indeed for last year, has always been the National Collateral Registry Integration Database of the credit bureaus. The goal of enforcing or implementing character over, collateral, and you see what the fintechs are doing. For instance, they don't ask you to bring this. You can argue that they are small loans, but they don't say bring this amount of property for you to get this loan. They just want to look at your credit scores. They want to look at how you've performed over time. If you've defaulted over time, or if you've even as much as signed a still check or a dot check, they simply don't give you the loan. But if you've been performing, you've been very, very precise with your repayments, and over time you've always fulfilled your obligation, you get the loan. Because now it's a question of, even though we don't know you, what does your financial footprint say about you? What does your credit personnel, in quotes, say about you? So if the performance is really accurate and good over time, you simply have a financial character, a sort of a reputational collateral to get the loan. But if you don't, then you don't get the loan. And it's important we emphasize that character, because that's the only way we are going to be able to reach out to a large base of our adult population.
Now, who pays for the services of the credit bureau? Is it the lender or the borrower?
Well, it's part it's part lender, it's part borrower. I mean, some financial institution have a smart way of making sure that the customer pays the liability. But you also have cases where the institution will pay the liability, for instance. But payment for credit bureau reports or credit scores in Nigeria are pretty subsidized to a very large extent. We have intervention from CBNs to say, look, you can't go past this ceiling, and this is how much reports you can charge, and we can subsidize in some way. So CBN has been very instrumental and very supportive. And under the banner of CBAN as well, we come together as an administration and say, look, the goal is financial inclusion. It's not profit at this point, so we need to extend in this space. And for that reason, our emphasis at this time cannot be on, profit or, so much money focused at this time. It's more about awareness, about reaching out to more people, about ensuring that we narrow down our Gini coefficient and other important variables. We increase our ease of doing business and all that. So it's been subsidized to a large extent. It's so subsidized that at times the customers don't even know that they are paying for reports.
It's been quite an interesting conversation with you, Chairman of Credit Bureau Association of Nigeria, Olajimide Peters. Thank you for speaking with us this morning.
Thank you very much. Thank you for having me.
All right, now, members of the Nigerian Stock Exchange at the 59th Annual General Meeting held on Wednesday voted overwhelmingly to support the listing of the Nigerian Exchange Group PLC on the Nigerian Exchange Limited once the demutualization of the NSE is completed. Some of the other key resolutions unanimously approved at the AGM include audited financial statements of the exchange for the year ended 31st December 2019 and the reports of the National Council and the auditors thereon following the conversion and the re-registration of the exchange as the Nigerian Exchange Group PLC. The powers of the National Council of the Exchange will be devolved upon the board of directors of the group, and the re-election of Mr. Bimbola Ogunbanjo as a member of the National Council was also confirmed at the meeting. Of course, the resolutions that were passed at the AGM, which is expected to be its last for the year as a mutual or be the last as a mutual entity, is subject to the receipt of requisite approvals of regulatory authorities following the conversion and re-registration of the Nigerian Exchange Group. All right, now let's quickly run through yesterday's numbers coming from the local stock markets, where the bull finally returned after 3 straight days of market correction. The all-share index jumped by 1.7%. That was due to major interest in cement manufacturers, Dangote Cement and WAPCO, as well as Nigerian breweries. The total volume of trades declined by 92.9% to 661.13 million units, valued at 8.3 billion. And exchanged in 7,321 deals. Transcore was the most traded stock by volume at 160.58 million units, while Guarantee was the most traded stock by value at 2.62 billion naira. But let's bring in a stockbroker at CSS Securities, Kayode Olayemi, to review those numbers and tell us what to expect for today. Good morning. So finally, the market got some breather yesterday. Are we likely to see this continue today?
I think the market had seen like 3 days of profit taking. So we saw buyers stepping into the market yesterday and renewed interest in the industrials, consumers, and in the banks. Generally, the sentiment is sort of risk on. So given people have sort of booked profits they've made from the very strong rally we have seen last couple of weeks. Going forward, I think probably should still see some more gains, given that investors are sort of looking for where to invest, given where yields are.
Stockbroker at CSS Securities, Kayode Olayemi, thanks for your input on the program.
Thank you.
All right, we'll touch base with London when we return in just a moment. Please stay with us. Juliana Olayinka joins us now for a review of today's headlines coming from the UK. Good morning, Juliana. Boris Johnson has approved a 4-year, £16.5 billion surge in defence budget at a crucial time in the economy when public finances have been overstretched due to the pandemic. Why is the military getting this much funding at this time?
Well, it's simply because it's needed. I think ever since the 2016 historic referendum on Britain's departure from Europe, Britain has been seen in some corners of the world as pretty much a laughingstock. We were going backwards and forwards for 3.5 years. It took 2 prime ministers to get us to the place that we're at. And I think the Prime Minister believes that now is the time to really cement Britain's international standing on the world. I believe during the discussion that the Prime Minister had with Vice President-elect Joe Biden last week, he reassured America of Britain being a strategic, strong ally. Britain want to use this extra £16.5 billion to cement its position as being the largest spender of military in Europe and the second largest spender of military in NATO, just behind America. Currently, Britain spends £42 billion a year on defence, which, if you think about it, is a lot of money. And in the past 4 years, of course, we had a pretty contentious foreign policy from President Donald Trump. We've seen the rise of China, and now cybercrime and space crime is becoming the norm. And for Britain to be able to solidify its position, it will have to spend money. I think I spoke a couple of days ago on this programme, it could have been yesterday, about the position of foreign overseas spending, which currently stands at 0.7% of GDP. There was some speculation that perhaps that could be reduced to 0.5%. And now with the reports of the defence spending today, we're probably expecting that this extra £16.5 billion will just be transferred from the overseas spend to military spend, which of course is going to raise eyebrows when the Prime Minister does deliver this announcement in front of lawmakers today.
To see how that goes. Now, Juliana, Christmas is already in the air, whether we like it or not. But residents of England will be getting tougher regional coronavirus rules next week regarding how families will see each other during the festive period. Any idea what the new rules will be?
Not necessarily. That it's trending on Twitter in Britain, Christmas Day, and a lot of the daily tabloids have got Christmas speculation on their front cover because, of course, Christmas is just a couple of weeks away. Right now, if we weren't in a lockdown, people would be ferociously spending, and it would definitely feel a lot more like Christmas. I think the government now are really trying their best to make sure families and loved ones can see themselves during the festive holiday. And yesterday we had a little bit of a taster of what that could be, but the COVID rates are still rising. Yesterday, I believe, over 19,000 people tested positive, over 520 people died. So it's still very much in the peak of the second wave of the crisis. And the data that we're getting out from the government's own scientific community are not really showing that this lockdown is working. We won't really know until the Christmas period, but that's, of course, the time when people want it off. So what we're expecting, of course, on December the 2nd is that this national lockdown will be lifted. We will be going back into some sort of tiered restrictions. There are some suggestions that perhaps hotels will be open, but restaurants will not be open. There are some suggestions that there will be 5 days where families can mix with 4 other households. At the moment, since March, the 4 nations, Northern Ireland, England, Wales and Scotland, have very much been doing their own thing. In fact, there's a huge devolution row going on at the moment between Boris Johnson and Nicola Sturgeon, the First Minister of Scotland. But they're trying to put that aside so that all 4 nations can have exactly the same restrictions lifted on that period. Because, of course, in the UK, people have loved ones up and down the length and breadth of Britain. But there will come a consequence. So we are expecting it to be not necessarily a lockdown, but much tougher in the days before Christmas, perhaps 5 days of relaxation, and then we'll go back into some sort of tougher lockdown. But it's all up in the air. It's all speculation, and that's one of the main issues that this Boris Johnson government has had during COVID, the fact that they're leaking information to the media before they're confirming it, as they should, to lawmakers in the House of Commons.
Well, we hope to get some clarity regarding that soon. But now let's talk Brexit, Juliana. Northern Ireland businesses are calling for an extension of the Brexit transition in the region. What's the reason for this?
Well, the reason is they're not ready. They're not ready at all. On the 1st of January, of course, the transition period comes to an end. We would have officially left. I believe business leaders in the Northern Ireland territory consider themselves the rope in the tug of war between Westminster and Brussels. Information that should take probably 2 years to process is going to have to be processed in 43 days. I believe the shadow Northern Ireland secretary on the Labour opposition party was at a webinar with about 150 different farmers in Northern Ireland who supplied £2.6 billion worth of agri-food to the UK. 95% of them had no idea of the paperwork that they were to be producing. A lot of their food goes through ports that are in Ireland. Of course, Ireland is in Europe. This wasn't a problem before, but it is going to be a problem now. And the issue is these checks. This is the contentious problem that America and Joe Biden have with Britain about this Good Friday Agreement and the troubles on the island of Ireland and there not being a hard border. But without some sort of customs checks, Britain, which is the Northern Ireland, will remain part of Europe. So it's a huge headache at the moment. We are expecting lots of delays, lots of queues. Even, I believe they were mentioning something as simple as labelling on food. How is this going to be done? There are major concerns, but as we know, January the 1st is enshrined in law. There are no ifs and no buts. Boris Johnson says that is the day and there will be no extension to that. But of course, Prime Minister Boris Johnson and this Conservative government are known for U-turns. But whether or not this Northern Ireland issue, which it is being considered, can be resolved in 43 days is extremely unlikely.
All right, Juliana, thank you. Do enjoy the rest of your day. And back home, a fixed income dealer at FSDH, Caleb Alimi, joins us now for an analysis of the fixed income market. Good morning. Thank you for joining us on the program. In just about a minute, give us an overview of activities at the fixed income space.
Okay, thank you for having me. Can you hear me loud and clear?
Loud and clear. Please go ahead.
Oh, fantastic. So the fixed income market, as you know, has been a bit, should I say, comatose in the last few days or in the last few weeks, and that's been due to, cash glut, so to say. We see that in the treasury bills market, which is the Nigerian treasury bill, NTBs. We've seen that rates have consistently fallen at every auction, and we can see that even the 1 year paper is trading below 0.3% at the moment. Let's take it to the bond auction. And the bond auction, there was a bond auction yesterday where the DMO sold a total of 80 billion of the 2035 and the 2045 maturities. They sold 40 billion each of both maturities. And for the 2035, which is a 15-year paper, we saw a slight increase, a 3 basis point increase from the last auction rate of 4.97 to 5%. And for the 20-year paper, the 5-year paper, we saw a decrease of about 20 basis points on that paper. We also saw that demand seems to be waning across the curve, but we expect that this should continue. We expect to see more demand as we end into the end of the year. That's due to the fact that we're looking for this. The investors are looking for a yield pickup across the curve, and that is becoming increasingly difficult to find. So we think that the fixed income market is going to remain at these levels and will continue to decline, especially for the Nigerian treasury bills and the bonds. Thank you.
Fixed income dealer at FSDH Merchant Bank, Caleb Alimi, thank you for your time this morning. And that's where we end today's program. Thank you for watching. I am Bisi Adebayo.